Somewhere on Long Island, hidden inside a highly secretive building, sits a financial engine that generated an average annual return of 66%. This chart shows a compound growth curve from 1988 to 2018. That 66% figure is before fees, including 0 losing years. $1 invested here grew to over $20,000, while $1 with Warren Buffett turned into roughly $100. The architect of this system never studied finance. He never worked a day at an investment bank, and he ignored traditional fundamental analysis. His name was Jim Simons. Instead of predicting market trends through intuition or gut instinct, he took a different path. He removed human emotion and judgment from the trading process. The most profitable financial engine in history systematically bypasses human behavior, prioritizing mathematical signals over the underlying logic of the market. The origins of this machine trace back to the 1960s on the academic campus of UC Berkeley. Simons was a mathematical child prodigy, reportedly computing large exponents in his head before grade school. By 23, he had his PhD, and soon co-developed the Chern-Simons theory. This branch of quantum field physics was purely abstract, providing 0 practical application for the stock market. But his career path quickly shifted from academic halls to the shadowy bunkers of Cold War military intelligence. The U.S. government employed some of the country's best mathematicians to crack encrypted Soviet military communications. Simons's job was to decode their transmissions. He spent years training his mind to execute one highly specific cognitive task, finding the hidden structural pattern buried inside data that looked to everyone else like pure static. Simons was building a cognitive framework to see underlying order within absolute chaos, a skill set far removed from the work of a traditional analyst. That intelligence career ended abruptly. Simons was fired for writing a public letter to the New York Times opposing the Vietnam War, while still on a defense payroll. Stripped of his clearance, his career detoured into strange territory. He moved to Bogotá, Colombia, where he and some graduate school friends took over a factory manufacturing floor tiles. It was loud, physical, and unpredictable. Managing that factory floor gave him his first exposure to real-world business operations and the daily logistics of managing commercial assets. When they successfully sold the Colombian venture in 1973, it handed Simons a massive, sudden influx of financial capital. He finally had the money to start trading. This political firing provided the essential raw materials for his next stage: direct commercial experience and the seed capital that a purely academic life could never generate. He brought his new capital back to the United States, taking aim at the human-driven establishment of Wall Street. Simons merged 3 disconnected threads: the capital from Bogotá, the abstract topology from Berkeley, and the Soviet code-breaking techniques. His algorithmic machine treats global financial markets as an ocean of encrypted data, deciphering signals hidden within the noise of daily trades. By relying strictly on automated data extraction, the firm insulated itself from the natural human panic and greed that reliably destroyed traditional investors. Jim Simons demonstrated that removing human judgment from the equation yields a level of consistency the traditional establishment could never match. In 1978, mathematician Jim Simons left academia to trade full-time on Wall Street. But despite his genius, his initial returns were completely unremarkable. He was building his portfolio on the exact same intuition and discretionary guesswork that every other macro trader relied on at the time. The problem with relying on human instinct is that human beings are emotional creatures. When markets become unpredictable, traders inevitably succumb to panic. Simons realized that to truly master the market, he needed to build a system completely incapable of feeling fear. He decided to pivot away from discretionary investing entirely. He wanted to engineer an automated machine that would execute trades based purely on math, without any human allowed to intervene in real time. Simons was declaring war on the very concept of human financial intuition. When he founded Renaissance Technologies in 1982, Simons made a decision that baffled the industry: an absolute refusal to hire anyone with a Wall Street background. He believed that market mechanics could easily be taught, but raw pattern recognition talent could not. Instead of slick brokers, he brought in physicists, mathematicians, and statisticians. He built an academic laboratory right in the middle of the financial world. This team began dumping massive, messy datasets into their computer models, hunting for faint correlations in weather patterns, shipping logs, and deep historical pricing. They established a strict rule. Once a trading signal was rigorously tested and approved, it was handed over entirely to the machine. No one was allowed to pause it or second-guess it. Renaissance successfully scrubbed the Wall Street ego from its execution process, creating a pure data processing system. But that system was about to face a catastrophic failure. In 1988, Renaissance launched a new portfolio called the Medallion Fund. Its first 2 years were a disaster. This chart shows Medallion's early performance. They scraped by with a mediocre 9% return in 1988 and then dropped into a 4% loss in 1989. Inside the firm, the scientists began to wonder if the core premise of mathematical trading was inherently flawed. Simons brought in a Berkeley colleague, Elwyn Berlekamp, to rebuild the model. They shifted their focus to high-frequency, shorter-term trades. They applied principles from information theory to rigidly dictate position sizing. This eliminated the final human element from their process, the guesswork of how much money to bet. The result was immediate. In 1990, Medallion delivered a massive 55% return. By using math to engineer human guesswork entirely out of their risk management, Renaissance had created a strategy that could function independently of human sentiment. In the early 1990s, extreme market volatility created a high-stakes environment where every quantitative model was put to the test. Medallion's predictions suddenly disconnected from actual market behavior. Signals that had been highly reliable were now generating steep, unexpected losses. The team inside Renaissance felt an overwhelming urge to intervene. The natural human reaction was to step in, override the system, and stop the bleeding out of pure panic. But Simons had spent part of the Cold War decoding encrypted Soviet transmissions. That work taught him how to trust the underlying mathematical structure of a signal, even when the surface data looked like random static. He told his team, "It's not me, it's the data." He completely rejected their fear and refused to let anyone touch the machine. Left alone, the strategy recovered, proving that the unyielding discipline of an algorithmic model could outlast human reactivity. Medallion's historic success required brilliant physicists and massive datasets, but its survival came down to Simons' iron-willed discipline to eradicate human panic from his company entirely. For decades, the undisputed kings of finance built their empires on human intuition. Investors like Warren Buffett amassed legendary wealth by analyzing companies, understanding the broader economy, and making deeply researched, lifelong bets. Even highly aggressive speculators followed a similar path. Traders like George Soros made billions by reading macroeconomic trends and anticipating how human psychology would move global markets. Both approaches required a single individual to have a sharper opinion than everyone else in the room. But academia has a long-standing rule about this kind of success. This graph plots the efficient market theory. The market is too efficient to beat consistently. But the Medallion Fund made that theory look incomplete. For 3 decades, it outperformed the average by massive margins every single year, without a losing stretch. In total, the fund generated over $100 billion in trading profits. That figure exceeds the combined career gains of Buffett and Soros, the very men who defined the traditional limits of wealth generation. The architect of this anomaly was Jim Simons. He was a mathematician who looked at the methods of Wall Street, rejected them entirely, and built a massive wealth-generating system from the ground up using nothing but raw data. Simons' success suggested a different reality. The greatest liability in a portfolio is often the biological limits and emotional biases of the person managing it. Simons' approach bypassed human opinions. His team ignored company fundamentals and economic predictions. They focused exclusively on the extraction of raw, emotionless data. This scatterplot displays their core strategy. Algorithms hunted for tiny, fleeting statistical anomalies inside random market noise. By zooming out, we see the real engine, trading thousands of these micro-patterns simultaneously, allowing tiny fractions of a cent to aggregate into massive returns. Executing at that volume required a different kind of infrastructure. There was no screaming trading pit. Instead, Medallion relied on industrial-scale computational hardware, rows of humming servers processing thousands of calculations a second. By placing millions of mathematically verified microbets, Simons effectively removed the risk of the single catastrophic bad call that has historically ended the careers of human traders. The ultimate test arrived with the 2008 financial crisis. Global markets collapsed, and trillions of dollars evaporated in a matter of months. Across Wall Street, human panic took over. Traditional market signals failed, and some of the most respected names in finance abandoned their strategies as fear and uncertainty paralyzed their operations. Medallion's machines did not panic. While human operators were paralyzed, the algorithms continued hunting for anomalies and executing trades without any hesitation or emotional interference. The system viewed the catastrophic global chaos merely as a new, highly active dataset to exploit. Medallion ended 2008 with a return of approximately 80%. The fund's performance during the collapse demonstrated that a sufficiently disciplined mathematical framework can treat systemic chaos as an exploitable resource. What is the lesson for the modern trader? Most people don't have access to a supercomputer or a team of mathematicians to replicate these results. The value is in the definition of discipline. The popular image of a great trader is someone white-knuckling a massive position through their own personal doubt, waiting for one big bet to pay off. Simons operated on a different principle, having the conviction to trust a validated process, even when short-term market noise suggests that the process is failing. Looking at this dashboard, you can see the psychological challenge. When the data line drops and the market looks terrifying, human instinct demands intervention. Simon's actual achievement was refusing to let fear press that override button. Jim Simons avoided the spotlight because his legacy was never about a single, ego-driven legendary trade. He spent 30 years proving that human ego and gut feelings are often the greatest obstacles to consistent returns. The most durable edge in the markets is a mathematical process disciplined enough to outlast human doubt, especially the doubt of the person who created it.